What does a recession mean for the stock market? In this video, we'll explain how the economy works and how that can make stocks go up or down. And to do that, we'll speak with a famous economist, David Rosenberg. Now, David thinks the US economy might already be showing signs of heading towards a recession. Coming up, he'll explain why, and we'll tell you what he would be investing in given that economic outlook. So let's get started with this week's Ticker Take. Now, before we get into our conversation with David Rosenberg, Caroline is going to help explain how the economy actually works by playing the role of a generic farmer. Hello, generic farmer.
Hello, John. It's great to be with you from my generic farm where I live a generic farmer life.
And what do you grow on that generic farm of yours?
Oh, come on, John. You said you wanted generic. Well, there's nothing more generic than good old-fashioned tomatoes.
Okay, terrific. So it sounds like you're really at the center of how the economy works. Can you explain that?
That's right, John. The community needs to eat, so I grow these fine, sweet tomatoes and I share them with the community in exchange for money. And then I use that money to buy equipment like this trusty shovel here. And then the shovel company pays their workers and those workers spend their money. And it goes on and on and on. And that's the economy.
Okay, makes sense. Now, in the stock market, everyone's always trying to predict what might change the outlook for the economy. How does that work?
Oh, come on, John. I know you didn't just fall off a turnip wagon. What if there's a drought? If I've got less tomatoes to sell, I've got less money to spend, and I might not buy myself a fancy new shovel. That's consumer spending, John. And what if less spending means fewer jobs? That's unemployment, John. Oh, and what if less tomatoes means I have to raise my prices? That's inflation, John. And then if everyone raises their prices, the central banks get worried that everyone's going to feel poor, so they raise their rates to stop inflation. But then it gets harder for people to borrow money because the interest rates are high, so the economy cools down. That's the economy, John. All of that flow back and forth.
Good stuff. Okay, generic farmer, thank you very much.
Have a nice day.
And that brings us to our guest today, David Rosenberg of Rosenberg Research, who perhaps is best known for seeing the great financial crisis coming back in 2008, and the decade before that, seeing some of the warning signs around the dot-com bubble. David, it is great to have you with us here on Ticker Take.
Well, John, thanks for inviting me, and congratulations on your new endeavor.
Thank you.
And I was going to say how apropos that you bring the economist on to discuss fertilizer right after the farmer.
Touche. Yeah, well, we wanted to give people a sense to better understand the economy. And one of the reasons we wanted to talk to you was to better understand how the economy shapes Wall Street. So for those who are curious, how much of the business of Wall Street is tied to this idea of the economy or where the economy might be going?
Well, it's very tightly linked for one particular reason, which is that when you're in the equity market, you're paying for something. And the something you're paying for are profits. Where do profits come from? Not from thin air. They come from the economy. So if you get the economy right and you get the profit cycle right, you've done a big part of the work as to how you want to be positioned in the stock market or not. That's why it's so important.
And when we're talking about stocks, individual stocks, a lot of times we're looking at these different metrics like the valuation of the company or what the growth could look like over the next 5 years. But if somebody's trying to pick a stock while they're looking at the economy itself, what should they be looking at with respect to the economy when they're trying to make that investing decision?
Well, I always approach it from what we call a top-down perspective. So what I want to do first is get the sector right. Like, do I see bright lights coming, for example, in the energy sector or say in the technology sector? I want to get the sector call right. That's another thing we have to look at in the economy is not just the broad economy, but what are the sectors driving the growth? Like, for example, right now, the only source of exuberance and enthusiasm and growth coming out of the U.S. economy is AI. And anything related to AI and the proliferation of data centers, so on and so forth. So you want to get the sector call. Then you want to own really the best in class stocks. within that particular sector or subsector. So you want to take a look, always and everywhere, look at the fundamentals. And what are the fundamentals? Strong balance sheets. Strong balance sheets, low levels of debt, a low level of debt rollover calendar, sustainable cash flows, dividend growth, dividend yield. So you want to take a look at earnings visibility. But I look at it, not just the stock market itself, but when I'm talking about a specific company, I might not want to own a great company that's in a sector that I don't think is going to be doing very well. Okay. I'd rather own a not so great stock in a sector that's going to have tailwinds. So start with the sector, subsector. There's 11 sectors to choose from in the TSX or the S&P 500. Get the sector call right, then drill down to the best in class stock in that particular sector. That's my advice.
And then when it comes to the overall economy, there's things we sometimes hear like recessions. And obviously, people get worried about recessions in part because, maybe that's going to impact things like profits for companies. There's this classic definition of 2 consecutive quarters of declining economic activity that many on Wall Street use to define a recession. But how do you define a recession?
Well, I define a recession. Well, I define a weakening economy is when your neighbor loses his job, and the recession is when you lose your job. So that's a distinction. But all joking aside, and recessions aren't a joke. They are declines in overall economic activity, rising levels of unemployment, job loss. It's not true that it's strictly defined as a 2 quarters of negative GDP. That's a Wall Street colloquial, and I'll tell you why. The GDP numbers come out quarterly. We can hang on to them. But there's plenty of recessions where you don't get that back to back. You may get 2 quarters out of 3 that are negative or 3 out of 4. It's not like back to back. But Wall Street always needs a colloquial or it needs a rule of thumb. And that's what it gets with the back to back. The National Bureau of Economic Research, the NBER, which is not a government agency, it is a private sector think tank. They are the final arbiters of all the recessions. They date the start of the recession and they start the end of the recession. And what's very interesting in this regard is that they told us, this is a bit funny actually, that the Great Recession started. They told us it started. The announcement came December 2008. You understand how ridiculous that is? That was basically it was 2 months after Lehman had already collapsed.
Yeah.
What's interesting is that they dated the recession to December 2007, when everybody and their mother on Wall Street and Main Street and Boylston Street or whatever street were still calling for a soft landing. You had people calling for a soft landing after they cleaned up Bear Stearns, which was March of 2008. They dated the recession to December of 2007. And 12 months later, they tell us that that's when the recession started. And it's not that they're stupid or that they're lazy. They're waiting for something to happen. What they're waiting for is they're waiting for all the revisions. And this is what people don't understand. People that trade around the data or people that think, okay, back-to-back quarters of negative GDP, because what you get in time A is not always what you get in time E, F, and G. Because the first release of all the data, it could be the employment data, it could be the retail sales data, the industrial production data, the GDP data. The first sample always has a low sample size. It has a high error term. And then the government statisticians get more and more data. They get more and more tax collections. They get missing pieces of the puzzle they didn't have. Because what they try and do, I mean, think of something like retail sales. Think of how big a sector that is. And they get the numbers to us so quickly. How do they do that? Well, a lot of it is the first release is guesswork. But the markets will still trade around a number that has a very wide error term. So they wait for all the revisions. So that's why quite often we're in a recession. People don't even know it. And they'll say, oh, well, it's not in the data yet. Well, just wait for all the revisions to come in. And that's why they wait so long meticulously to actually date the recession for when they date the recession. I think that it's basically, you have to take a look. The economy is a complex organism. But really what it comes down to it is a pernicious, sustained over several months, decline in overall economic activity. The reality is that you've never had a recession without job loss. Now, in Canada right now, you're seeing the job loss. In the United States, it hasn't really happened yet. It's a bit of a lagging indicator because when you start firing people on net, that's when the rubber meets the road. That's when you can't hang on to your staff anymore. That's the last man standing heading into recession. However, it's a confirming indicator. If you're going to ask me, what is the one indicator you'll look at for the recession? No, it's not retail sales. It's not industrial production. It might not even be GDP. It's about the labor market. Once you start to see employment go down, and I would say not for 1 month, but let's say for 3 months, as they say on the Quebec side of the border, les jeux sont faits. The gig is up. So that's really where everything hits home, is when you start getting the net declines in employment. By the way, it's happening in Canada as we speak. And in the United States, there's a variety of surveys. The survey in the United States, that's like the one in Canada, the household survey, is showing job loss. But the beloved non-farm payrolls, and that's what everybody trades off of, it's showing slowdown. It's not showing declines just yet. But when that happens, the recession that I have been calling for is going to start to get more fully priced into the financial markets.
So that's an important point that you have already said very publicly, that you believe the U.S. is in recession. Now, you just alluded to some of the considerations, but can you just clarify what it is you have seen in the economy that leads you in that direction?
Fine. Well, I didn't say we're in a recession yet.
Okay.
Okay, because I just finished saying that it's when the employment starts to go down. Now, look, these numbers may get revised. We just got that non-farm payroll report for May, and the revisions to the back months were rather substantial. What is it I'm looking at? I'm looking at what Fed and what Wall Street pundits call the soft data. So there is a huge dichotomy now between the soft data and the hard data. Now, what they call the hard data is what I was talking about. The hard data: employment, GDP, retail sales, industrial production, shipments, orders, stuff that has a dollar sign in front of it. That's what's called the hard data. The soft data are more anecdotal. What are CEOs saying? What are the surveys saying? We actually have an algorithm that contains all the survey data. This is for the United States because there's a plethora of monthly surveys that come out from the Fed, in particular on manufacturing and on services. And of course, we have all the different consumer sentiment surveys as well. We roll this into a GDP model, okay? And it's right now saying that the US economy is declining at more than a 1% annual rate. But you look at the official statistics, and it's telling you, no, it's actually plus 2%. So I look at the GDP numbers from the Bureau of Labor Statistics, oh, plus 2. But you see, we modeled out the soft data, it's minus 1. The thing about the soft data doesn't get revised, okay? Like when you look at the non-farm payrolls or the employment numbers, they don't tell you about your mood. They don't tell you about what you're probably going to be doing. It's just a number. The survey data are rich in information about the most important thing for economics. Economics, after all, is a social science. And it is a science of behavior in an economic sense. Business behavior, household behavior. You don't get that in the hard data. And all the economists, they focus on the hard data. The thing is that the soft data lead the hard data. The soft data are telling you right now that underneath this, say, illusion of positive economic growth in the hard data, which I think will be revised, telling you there's a very soft underbelly. Let me give you an example of what I'm talking about. There's this document, and you do know what I'm talking about because we talked about this before. The Fed's Beige Book, for example.
Sure.
So the Fed's Beige Book, it comes out every 6 weeks. It's been published since 1970. It's the Fed staff going out into the field across all 12 regions of the United States, and they're talking to business owners across industry, across regions. It is the most comprehensive look at the U.S. economy. It comes out every 6 weeks. What did it just say? We just got the latest one, the latest Beige Book for last week. It's called the Beige Book because the cover is beige. I get that question all the time.
Thank you for
clarifying. But what's more important is, what did it just say? Okay. It just told us, John, it just told us that 3/4 of the U.S. economy right now, 3/4, is either flat or contracting. And the previous 2 Beige Books, It was 50%, now it's 75%. So I looked at that beige book, and we sort of run our own little data science behind it. And the tone of the beige book was identical to the month prior to the past 6 recessions. So that's telling us something, right? I looked at the last FOMC meeting. Okay, I looked at the last Fed meeting. We have another Fed meeting. Okay, we got the minutes of the meeting. At the beginning of these FOMC minutes, the first thing that you see is the Fed staff economist's forecast. That's at the beginning of every set of FOMC minutes. The Fed staff in the previous meeting in May, it was just like yesterday practically, they lowered their GDP forecast for this year and next year. But even as they reduced their baseline forecast, you know what they said? They said the odds of recession now are as high as our baseline forecast. Let me get this straight. The baseline forecast that you just cut, you're saying recession odds are equal to that reduced forecast. So I'm not going to say that the Fed staff, although they have one huge macroeconometric model, I'm not going to say it's gospel. But I am going to say that if the Fed staff, the economic staff of the Fed is saying recession odds are 50%, as an investor, you should be asking, what is out there that's remotely priced for even 50% recession? You see, the thing is that there's all sorts of recession probabilities. It's funny because I always say, well, is it 30% recession odds, 80%? It's like, are you 30% pregnant? Are you 80% pregnant? I mean, you're pregnant.
Yeah.
But the thing is that in our business, you see, being pregnant or not is not a shade of gray. In our business, you and me, there is shades of gray because nothing's ever black and white in the financial business or the economic business. So basically, to have the Fed staff, who usually are a very cheery bunch, say that the recession odds are 50%, you got to be thinking, like, you look at the multiples in the stock market now, you look at credit spreads in the bond market now, you look at how elevated bond yields are right now in the government bond yield market. There's nothing out there that's priced for even 50% recession odds. And that's really what I'm looking at, because this is really a game. The game we're playing is a game of probabilities at all times.
Now, with all of that said, what has history taught you about the stock market and how it performs when there is a recession?
So when you're in a recession, you get a decline in economic activity. That decline in economic activity involves declining corporate profits. If you're in the stock market, you want to buy a positive earnings stream. And in recessions, you don't get it. Profits go down. Now, the thing is that in the household sector, even though it's really tough, personal incomes tend to be a little more sticky. Okay, so wage income, and maybe a lot of it is because of unionization, so on and so forth. Wages could go down in a recession, but not by much. Generally, they just don't go up. But profits are a lot more volatile. In a recession, profits couldn't go down between 20 and 30%. Incomes might go down 1 or 2%. Incomes tend to be more stable in the personal sector, but they're more volatile. And that's why you get huge bull markets and you get huge bear markets. Because income in the corporate sector is more variable than it is in the personal sector. And on top of that, what about the price earnings multiple? Because how you derive the value, say, of the S&P 500 is the product of two numbers. What is the E? What's the earnings? And then what is the multiple that investors are going to slap on those earnings? What is the multiple? Because you're paying for those earnings. And you're paying for earnings in a long duration asset called equities. So you're really talking about a multiple based on expectations. So the multiple is the heartbeat of expectations. What are you willing to pay for that earning stream in October is not necessarily the same as it's going to be in June. It's going to move around with the interest rate cycle. It's going to move around with the economic cycle. So when you get a situation, for example, as we were, let's just say in 2024, and the AI craze. We have the economy accelerating. We have profits accelerating. And when you're in that sort of enthusiastic mode, this is where sentiment plays a big role. The multiple also expands. Not just earnings going up, but you're willing as an investor to pay more for that future earning stream. That's confidence. That's what you get in a bull market, and that's what you get in a bull market related to an economic expansion. When the movie runs in reverse, when you get the recession, not only do you get the hit from actual earnings going down, but the price earnings multiple goes down because the confidence that investors have in the future earnings stream goes down. So you get the double whammy. You get the double whammy. Lower earnings, lower multiple, and that's why you can get in a bear market a decline in the S&P 500 of as much as 30 to 40%, if not more. And when you go into these things with a high multiple because of huge exuberance, and as if we didn't see that, look at the big bear market. Look at the big bear market in 2001, 2002, the tech wreck. It's interesting that it was the mildest recession in modern history, and it produced like a 60% bear market in equities because the multiple contracted so dramatically off that bubble peak. And right now, we're in basically the top 10, 15% of multiples of all time. Like right now, it's not just the problem of what earnings will do in an economic recession. It's that we're coming at the starting point of the multiple it's at bubble-like levels. And that's what will take the next bear market to be, shall we say, on the pernicious side. It won't take a huge recession to generate a big bear market, because the multiple will contract and do most of that heavy lift to the downside.
Given everything you're saying,
is that cheery enough for you?
Well, it's helpful context for what we're seeing in the market and what you're seeing in the economic data. I think one of the biggest challenges for people who are investing in the stock market is that they have seen time and again, especially with technology and the growth that it offers people, and then you add the AI story to that as well, they have seen opportunity. And not only have they seen opportunity, they have also seen when there are moments of weakness for those stocks, that those have proven to be on average opportunities, because on average, the group has had a lot of momentum. So for people who are afraid to give that up, even if you're seeing signs that inevitably things change, how do you navigate that?
Well, firstly, I would just say that my advice to the folks that you just referenced is fall in love with your partner, not your portfolio. It might not love you back so much. The reality is that we have not had a recession, and we had a 2-month recession during the pandemic. And it wasn't until the policymakers went gangbusters on stimulus, monetary and fiscal. You still had a 35% decline in that period. We had a recession before then, which was the Great Recession. Well, all those great concept stocks and all those great internet stocks and technology stocks, they got crushed. And that was in 08 and 09. That's not even 2001, 2002. So that's why the recession call is a big call. You're only going to be saved if you're in really the most defensive parts of the market. There is one stock that's never crushed you. I always say there's really two stocks that, with a fair amount of reliability, don't kill you if you have to be in the stock market. There's only two stocks that you'd want to be left with, historically speaking. You want to know what they are?
I do. I think everybody wants to know.
Walmart and Microsoft. So what you would almost say two defensive growth. One in the retailing arena and one in the high tech arena. But they are defensive growth with strong balance sheets. So there, I just let the cat out of the bag. However, I will say that a lot of it depends on your time horizon. Like for anybody who's watching this who is in my age, say in their mid-60s, I can't believe I just said that. When I go shave in the morning, in front of the mirror, I say hi stranger, like who are you? But if you're my vintage, the hourglass is not in your favor, and you want to be more risk averse. If you're like in your 20s or even in your 30s, you could ride out the cycle. Then yeah, I would say that stick to the AI story, stick to the growth. Close your eyes and just move on, because the S&P 500, the way it's constructed and with the survivorship bias, like I would just say, basically to your answer, just buy the index, just buy the S&P 500. It's the best companies in the world. And look, I started in the business on October 19th, 1987. You know what I'm talking about? 23% plunge. People thought there was going to be a depression. Now, there was a time in 1988, 1989, 1990, you looked at the chart and you could see October 87. You should put that chart up and show, do you see October 87? I started that day. It was my first day on the trading floor. People were hanging from chandeliers at the Bank of Nova Scotia on the trading floor. So if you have a 10, 20, 30-year time horizon, I'd say just buy the S&P 500. But you see, the thing is that it's easy to say, just people aren't built that way. Okay, like there's so much emotion involved in investing. I always say, put the emotions aside. Easier said than done. There is so much emotion. So if you get a 10% blip, people go nuts. 20%, oh my God, the world's ending. Don't forget the last few bear markets. The last 3 bear markets were like 30 to 50%. And yet you go back and you make new highs. So I would just say it depends on your time horizon. Some people like to trade the market. People that like to do it year by year and then evaluate. Those are the people that are my clients. People that are just say, 10, 20, 30 years, no problem, then just ride it out. But I'll tell you, that's what my clients say to me, I'm a long-term investor. And yet they're looking at their phone every 10 minutes for what the portfolio was doing. So easier said than done. Depends really on the age profile, and it depends on your tolerance for risk, and it depends on your time horizon. Because everything you and I are talking about right now is immaterial. If you're going to tell me, and people tell me I have a 20-year time span, or it could be a family office. Now, most family offices want to invest in more esoteric stuff, say like infrastructure, hard assets. But if you're in for the long haul, just buy the S&P 500. But if you do that, don't come crying to me when we have the recession, you're down 20%. Because I'll tell you, nobody can time the market effectively. You tell me you're in for 10, 20 years. The stock market could be down after a 5-year period from its previous peak. But the odds that it will ever be down over 10 years, over 20 years, over 30 years, that's just not going to happen. That's a 99.999 repeated, guarantee. So once again, that'd be my best long-term strategy, is just buy the best index.
And when it comes to the global stock market, when you look at stocks around the world, if we're in kind of an uncertain economic period going forward, how do you feel about other markets compared to, say, the S&P 500?
They're all correlated, right? So we're getting into, the old refrain about in the land of the blind, the one-eyed man is king. So it becomes a relative game. If you're a portfolio manager and you get graded by your clients by how bad you didn't do in a bear market, okay, that's great. But there's a lot of people out there that just don't like to lose money at all. So it's a relative game versus an absolute game. If we go into a bear market, it's not confined to the United States. It's not as if you're going to find, the U.S. is down, everybody else in the world is up. It's basically going to be, the rest of the world's going to be down by less. But again, it comes down to what your time horizon is. But we've been saying, look, and it's worked out really well. We were saying it since the beginning of the year, diversify outside the U.S. market. The U.S. market has been, after several years of outperformance, radical outperformance with the rest of the world. But every dog has his day, as you would know, because you have a dog.
I do.
And so it's a mean reversion trade and comes under the adage of anything that can't last forever by definition will not. And so the US outperformance, as impressive as it's been, is now mean reverting. There are other areas of the world to park your money in the equity market. So I don't believe in 0 or 100. I said before, there's nothing in our business that's black and white. I'm viewed as some radical perma bear, which believe me, I am not. I am deliberately cautious. I was brought up by depression-era parents, and I believe in thrift and savings and strong work ethic. Okay, and I don't believe that anything comes easy. But I will say that you should be diversified at all times, and then that shift your diversification based on where you think we're going in the economic cycle, and that's really what I offer. So it's never 0 or 100. I would say to investors now, whatever your comfort level is on the equity market, I would take down whatever I would take it down, whatever it is, take it down probably by half. I'm not saying go down to 0. I never ever said go down to 0. I was probably 15% in the equity market in 2007. I wasn't 0. And people who mirrored me actually thanked me. But I didn't say going to 0 because you can never be that arrogant that there's no such thing in this business as a sure thing. It's not 0 or 100. It's playing the probabilities, making sure you're diversified. But there's no doubt in my mind that if I'm going to be in the equity market today, and I am, I would rather be diversified outside the United States than inside the United States, 100%.
Now, since you've talked a lot about diversification, and you also talk a lot about the world of fixed income and bonds, what is your general view on investing, let's say, in US government bonds? And when you think about portfolio construction, how do bonds fit into a portfolio that might have more stocks than bonds?
Okay, well, there's lots to unpack there. Let me just say that I can understand why Treasury yields have been sticky to the downside. And they're basically in a range. So let's say we're close to 5% on the long bond, call it 4.3, 4.4, 4.5 for the 10-year Treasury note. And people are making up these narratives, like talking about fiscal policy and talking about the big, beautiful bill. And what I say is focus on what bond yields are correlated with. They only have a 20% correlation with these fiscal deficits. Okay, it's not 0, but people are taking their eye off the prize. What's the prize? What's the most important correlation with longer term Treasury yields? Is with Fed policy, the Fed funds rate, the cost to carry, and core inflation. So right now, the bond market's sort of caught in a box because the Fed's saying they're not going to be cutting rates, certainly before September, because they're so concerned about the tariffs. We haven't seen the inflation yet, and we just came off really a benign round of CPI and PPI data. But don't be fooled, because the business sector is working off the bloated inventories they built up before the tariffs. So they're working off their low-cost inventory. But the Fed's concerned about the extent of the tariff pass-through to inflation and whether or not it's going to feed into wages, which is why they're waiting for the labor market to crack, which I think it will, but that's what they're waiting for. But right now, the market priced out. Remember, back when the 10-year Treasury note yield was at 3.6% in September, and we're up almost 100 basis points since then. What changed was the market was pricing in 5 rate cuts for this year, and now we're down to 2. So that played a very big role because we're seeing in real time that inflation has actually still been coming down. Core inflation has been coming down. And I'm sure that if it weren't for Donald Trump, the Fed would be cutting rates right now. And the yield curve would be steepening, but the whole yield curve would be declining, and you'd be making some good money in long-term bonds from a capital appreciation standpoint. That's not happening, but I do think it's going to happen. I don't think we're going to get sustainable inflation out of the tariffs. I think it's going to hit the wall in the labor market, and it's going to mean lower real wages, and that's the economic contraction we're talking about. The lower real wages leads to lower real consumer spending, and that's almost 70% of the U.S. economy. It's not here yet, but I don't get paid to tell people what's happening today or what's happening yesterday, what I think is going to happen around the bend. And so I think that the Fed will be cutting rates. The more they wait, the more they'll have to do. I think that inflation will have a bump, and then it'll come right back down again. So I'm actually fairly constructive, despite all the warts and the scars and the pimples because of the fiscal side. I'm not saying the fiscal side is not important. I'm not saying that the fact we have this monumental government debt rollover calendar and all the other new issuance from these deficits. It's only problematic in the sense that it'll limit the sort of declines we get in bond yields. It will not prevent it from happening, okay? Especially if I'm right on the recession call. Show me a recession. Show me a recession where treasury notes and bonds didn't make you money. Even in the 1970s, in the stagflation, in a recession, you wish, even with the deficits going up a lot as well, and even with the real sticky inflation back then, bonds did a lot better than equities did in a recession. So it comes down, of course, because what does a recession do? It does cause you to shift out of risk assets into more riskless assets. And that's the one thing I want to say about the treasury market or the government Canada bond market or any market that's got a government guarantee. Does your equity portfolio have a government guarantee? No. It has an explicit guarantee. The bond market is the only asset class that has certainty of payment characteristics. You know, I can't tell you how many times I have to field questions from my own clients frustrated over the bond market. You're not buying bonds to make a killing. You're buying bonds as an insurance policy, as a source of diversification. Diversification because it offers things that your stock portfolio that you love so much don't offer you. Okay, the bond market matures. The bond market matures. You're not going to make a loss if yields go up so long as you hold on to it till maturity. Equities don't have a maturity. There's no maturity date. So bonds are the only asset class where you know your coupon. The coupon's not going to get cut. It's not like a company in cash flow difficulties is going to cut its dividend. There's no dividend risk. You're going to get your coupon. The coupon you're going to get is with certainty, and you know at the end of the maturity date exactly what you are going to get paid. So I have to basically wash, rinse, repeat this message to people that don't understand the bond market. Oh, the stock market, they fully understand. Let me just say this much, okay? We had a dangerous situation back in 2000, 2001, okay? When the central banks flooded the system with liquidity. They were doing quantitative easing, once again, up the wazoo, and bond yields went down to almost zero. You remember back in 2001, the 10-year Treasury note yield was so low, so stupid microscopic low, that it only took a 7 basis point increase in the 10-year note, 7, to generate a net loss in your bond portfolio in real time. You had no coupon protection. Today, at roughly 4.5% of the 10-year note, you have a ton. You have a ton. Okay, we had the farmer on earlier. I'm not going to say the bad word. We have a fertilizer ton of coupon support right now. So right now, for you not to make money in your 10-year Treasury note, yields would have to go up 70 basis points from here. You know what I'm saying? We'd have to go above the October 2023 high. We'd have to go to a new cycle high on the 10-year Treasury note yield. And I don't think that's going to happen at all. I give that not zero, maybe a 1% chance of happening. But what if we went down 70 basis points? God forbid, 70 basis points takes us back to where we were in September of last year, okay? You go down 70 basis points, you're talking about over a 10% return in the 10-year Treasury. You'll make an equity-like return with the convexity in the bond market and the capital appreciation that you'll get. The long bond will give you a total return of well over 20%. So I know I've taken a long time to answer the question because I'm very passionate about this. You know, people are very passionate about equities. I'm passionate about bonds, which is why at the cocktail party, nobody wants to hang around me. You see that guy over there who talk about the treasury market? Who wants to hang around that guy? So, but in any event, I do think, and it is a high conviction call that the bond market, which is despised right now, and don't forget I'm a contrarian by nature, the much maligned bond market, I think, is going to offer up equity-like returns in the next 12 months. That'll be something that people should be looking at. That the safe, boring asset, much like gold, will deliver double-digit returns in the next year. Because I think yields are going to be coming down beyond Labor Day.
Well, I'm glad you brought up gold because I was going to ask you about it because you've been very vocal over several years, actually, about the fact that you've been bullish on bullion. And I've heard you say as well that, you know, If gold were to reach, call it $6,000 an ounce, that would not surprise you. Why are you generally still constructive on the story of gold, even after the run-up that we've already seen?
Well, it's to understand that this is situational. Jeff Gunlock, I think, was saying on CNBC recently, talking about that it's no longer for lunatics. Gold's no longer for lunatics, and like, we're friends. And I feel like saying, you shouldn't call me names on the airwaves. But the thing is that when I started turning bullish on gold, good grief, I think it was back in my tail end of my days working at Beano and Nesbitt, when you were still in kindergarten, and that was in like 1999 when the European central banks at the time announced the end. They announced a moratorium on their gold sales. You would say to me in 1999, I forget where we bought them, like $200 an ounce,
Something like that.
Yeah. So they were selling. It got to a point where it became global. The Bank Canada, and then it had no gold reserves at all. All the central banks, well, they were believing their own rhetoric, right? Their own price stability, and who wants to own gold with price stability. It's an inflation hedge. So the global central banks were dumping their gold on the market. And the central banks, so we talk about QE, the central banks with endless money to buy risk on their balance sheet. People in the gold market knew how important the monetary authorities were decades earlier because they were dumping their gold. It's not a surprise then, no coincidence, that the day gold bottomed decades ago was the same day that the European central banks announced the moratorium on their gold sales, and then the bull market started. And then it's taken on, different complexion. It's funny because it's rallying during deflationary periods, it's rallying during inflationary periods. So it's acting as a real bona fide balance in the portfolio. It's a hedge against the instability from deflation. It still has its natural hedge against inflation. And then you've got all these concerns, not necessarily that I share them. These might be from the lunatics, but all the currency debasement and so on and so forth, and a race to zero amongst all the currencies. And so gold is basically, gold is a currency that has no government's liability. That's one of the inherent quality characteristics of gold, that its supply is relatively fixed. And so it's interesting because in the past several months, gold's been hitting new highs in every single currency terms, not just the US dollar, the euro, the Australian dollar, the yen, sterling. So it's interesting, and maybe one of the reasons why Bitcoin's been so successful, at least this far. But they call it digital gold. I just like to buy the real thing. Thank you very much. But it's taken on the characteristics less of a commodity and more like a currency. It has had a currency that has no government's liability. And we talk about hedge against an increasingly uncertain geopolitical world, a world where fiscal deficits are adding to more uncertainty. Because how do you value gold in the end? Like, you value stocks. We talked before about the price earnings multiple. You can do the dividend discount model. You can look at price to book, price to sales, price to EBITDA. You do a corporate bond model on credit spreads and default rates, recovery. How do you really arithmetically, quantitatively value gold? How do you value gold? It's funny. People in Bitcoin say, well, I'm valuing Bitcoin over the outstanding value of gold. Like I say, I'll just buy the gold then. Gold is a very simple quotient, where it is 1 divided by C, where C is certainty. And Donald Trump, it's not MAGA. It's not. It's MUGA. MUGA. Make uncertainty great again. And whether it's over immigration, or whether it's over fiscal policy, whether it's over, of course, trade and tariffs. And there's measures of this. There are measures of uncertainty that go back decades. There's different measures of uncertainty. We actually model these too. We talked about the recession before. The level of uncertainty itself, because it's not just about the trade and tariffs, but the haphazard way reprieve one day, then not a reprieve, extended. People don't know how to plan. And that's enough, by the way, to shave 1 or 2 percentage points off GDP growth by just having, because when you're in this period of heightened and rising uncertainty, it freezes the business sector. They can't make decisions. They can't hire. They can't invest. And for people, they will then save more of their after-tax income because they're nervous. This is what's happened, whatever, maybe for the greater good to bring back steel and aluminum jobs in the United States. But the point is back to gold. Gold is a hedge against uncertainty. And we have uncertainty. This is Trump. Trump 2.0 is Trump 1.0 on steroids. And so the uncertainty factor is, and it's going to be with us. He's not going anywhere until for another 3.5 years. Finally, most important point, I come back to the central banks. What are they doing? What are central banks doing? They are buying gold. Gold now has replaced the euro as the number 2 asset on central bank balance sheets. So just as that, you were bearish on gold and right through the 1990s. You just looked at central bank balance sheets and you say they're dumping gold, and they have the deepest pockets in the world. And so they're buying gold. And it's not just the BRICS. It's not just Brazil and India and Russia and China. They're big. But every central bank now is diversifying more and more into gold bullion. So I would say there's 2 things. You're going to ask me, at what point is the cycle over? Now, we did a lot of work on this and found that our belief is at the peak. If this follows other bull market cycles, the peak will be $6,000 an ounce. So it's not going to go up another 15-fold from here, but it's probably going to double in the next 3 to 5 years. The day that you get a moratorium announced, that the central banks are stopping buying gold, that's an important sign. But I'll tell you a more important sign than that. That will be the best contrarian sign that the gold bull market is over, is when Rosenberg changes his name to Goldberg. You'll know it's over at that point. But no, that's a high conviction call. I had 2 high conviction calls, bonds and bullion. I call it the bond bullion barbell. The bond bullion barbell, by the way, so far this year is up 20%. 20%. The S&P's up like 2.
We did invite you to come on Ticker Take because obviously people are looking for investing perspective, and you've got a lot of it on that front. You mentioned Bitcoin a couple of times when you were referencing gold. And in the past, when people have done a direct comparison between the two, I think this is a direct quote that you called it an absurd comparison. Where do you stand today, though, when you think about Bitcoin and everything you just and the people who have conviction around similar themes that you just talked about with gold, but they believe more strongly in cryptocurrency?
Mm-hmm. Well, look, I have not owned crypto. I doubt that I will own crypto. And it could just be based on my extreme high level of ignorance around the crypto space. I like gold because, like bonds, it is not correlated with my equity portfolio. I don't want, no matter how big my equity portfolio is, I don't want other asset classes being correlated with it. Because if you have your other parts of your portfolio correlated with the S&P 500, why not just go out and buy the S&P 500, just own 100% of it? You want to be diversified. You want to have things in there that aren't correlated. So the thing about, they call it digital gold, but it actually has as much of a correlation with the NASDAQ 100 Bitcoin as it has with gold. But gold doesn't have a correlation with the NASDAQ 100. It doesn't. So therefore, I want to own it along with the other things in my portfolio. And I do have risky things in my portfolio, but I would say that crypto is just a little too high octane for me. Okay, let me tell you something, okay? I was in Winnipeg, Manitoba last year. I was speaking at a conference. Guy says in the Q&A, I want to ask your opinion, Mr. Rosenberg. To which I said, you can call me Dave. Only my kids call me Mr. Rosenberg. He says, I'm thinking of buying a Bitcoin for my mother on her birthday. What do you think about that? I said, I'm actually totally on board. And you could hear a hush in the crowd. I said, so long as you barbell it with a pacemaker. Okay.
Well played, Goldberg.
Oh, don't say that. We're still like we're $2,600 away.
We've covered a lot of ground, and it's great to get your perspective. We launched Ticker Take with a pretty simple goal to help people better understand the world of the markets and to make smart decisions around that. In all the years that you have been covering the economy and following the markets, being part of the markets, what would be the biggest lesson you would share with people about what it means to be in the markets? What's the biggest thing to think about, do you think?
Okay. The biggest thing to think about in 2 words or less, which, as you know, is a challenge for me, is risk management. Risk management, which means be disciplined. I said before, fall in love with your partner. Don't fall in love with your portfolio. And to make sure that so long as you don't have the luxury of having a 10, 20, or 30-year view, invest around the cycle. Invest around the cycle, whether it's about your asset mix or whether it's about your sector orientation within the equity market. As the cycle matures and goes into a recession, and recessions are nasty, but they're part of economic life. You don't want to participate in them if you don't have to. I would say even if you have a long-term view, you'd rather not have to participate in a bear market or a recession. So you want to basically manage your risk. You want to make sure that you don't have too much cyclicality, which is economic sensitivity, in your portfolio. And you want to make sure that you don't have a very volatile but a much more stable portfolio right now. That's what I would be recommending. So I mentioned before about Walmart and Microsoft. Well, there's your barbell in the stock market, defensive growth that won't hurt you. That's what you want to focus on. When I talk about risk management, you want to make sure that you do not participate in a big drawdown, but that you do participate on the upside. And that's where you want to be balanced, especially at this point in the cycle. You want to make sure that you do not want to right now. You see, I would say in a year's time, I'll be talking about something different. And coming out of the pandemic or coming out of, say, the 2022 drawdown, you want to start at that point shifting more towards an equity orientation. We're in a different part of the cycle right now where you want to be curbing your enthusiasm when it comes to the stock market. You want to own what's out of favor, and bonds are out of favor. And you could say, well, but gold's certainly out of favor. Yes, that much is true. However, the dynamics behind gold, which are the central banks, is not changing. I'll wait for the day that the Wall Street Journal says to me, global central banks should stop buying gold. So start exercising some prudence and some discipline and paying attention to what the driving factors are. The good thing about gold is that it will not hurt you in a recession. Good thing about bonds is that they will not hurt you in a recession. And I'm not going to sit here and guarantee a recession except to say that the odds are high and rising. And in this game of attaching probabilities and scenarios, I think you want to make that not your only scenario, but your base case scenario. So call the portfolio to best ideas, high conviction themes that will not move with the economic cycle. That day will come. When we go from recession to recovery, believe me, you'll want to own a lot of the economic sensitives and own a lot of equities, even on a short-term basis. That'll be the 2026 story, and hopefully you'll have me on between now and then.
That would be an absolute pleasure. David, thanks very much for stopping by. We really appreciate your insight.
Same. Great being here.
All right. Our thanks to David Rosenberg.
And if you'd like to learn more about David, we've put a link in our description with more information.
And how about that farmer?
Oh, she was something.
As for something else, we've got a weekly investing newsletter on Substack, and we've put a link in the description as well if you want to subscribe.
And speaking of subscribing, if you're not subscribed to our channel, what are you waiting for? Hit that subscribe button so you don't miss our next investing video. See you next time.
I mean, you look kind of funny. That's the shot.
Different considerations.
What did your fridge have to eat?
What? No, that wasn't right.